This is the walkthrough problem for common sizing. In this video, we will be common sizing a balance sheet and income statement. If you'd like to follow along with this video, you can download the Excel file. You'll also find that the solutions for this are on the next tab over. So when common sizing a balance sheet or income statement, this is going to make it easier to compare company to company, no matter the size of the company. Obviously, you're going to want to compare companies that are similar and not completely different in sectors. So when starting a balance sheet, you got to remember that there's an accounting equation that holds true for this as well. So your assets equal your liabilities plus owner's equity. So one side of the equation and the other side of the equation. So this holds true when doing this. For example, cash as a percent of our total assets is 1.45%. So we have 1.45% of our total assets are cash, and we can do that for all of the assets. We skip current assets. Alright, so now we have total assets, of which we do not calculate, or we can, which will just be the total amount over the total amount, which will just be 100%, or we can do, our current assets will just be our total current assets over our total assets. So we have of our assets, 48.49% of them are current assets. So when doing liability and owner's equity accounts, we're going to be referencing the total because that is the other side of the equation. For instance, accounts payable will just be that 7,220 divided by our 33. So of the owner's equity, so the claim side of the equation, we will find that 21.84% are our accounts payable, and we can do that for the rest of the income statement, the balance sheet. So of the total liabilities, so of our entire balance sheet on the claim side, we will see that 63.61% of our total liabilities make up the claim side of our balance sheet. So people claim more of our company than we theoretically own. And then we will see that the other percentage of it goes to our owner's equity, the portion that we, the owners, own. And we'll find that if we add those together, that's 100%, as we would expect. Now with income statement, we want to choose one variable. So for instance, you would either choose net income or revenue. In this example, we will go to we will go towards revenue. So if we take a percent of revenue, we should expect 100%. So that is true. So cost of goods sold as a percent of revenues, so we get a 66.46%. So of revenues, 66.46% of it is going towards cost of goods sold. And our gross profit, so of that 100% minus 66%, 33%. So of the revenue that we're getting, we're receiving 33% of it, and we can continue to do this all the way down the income statement. There we go. And then net operating income. And then interest expense. Earnings before taxes. As well as taxes. And then net income. So of the revenue that we're getting, all the way down to the net income, we're only getting 2.48% of our revenue that trickles down to net income.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.